Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only.
Check, check, check. Okay, so hey everybody, let's do a little video on our ongoing crypto, Bitcoin to be specific, income trade. So our Bitcoin income trade, we are long IBIT and we are using options as a lever, right? So the whole idea with the strategy is that we're going to be using different things. We can use covered calls, we can go in the money, we can go at the money, we can go out of the money, depending on what certain indicators are telling us, our MTI, looking at the charts, looking for breakouts, breakdowns, consolidation periods. So there are a lot of different things we can do. We can do callers, we can do other kinds of protective things. So let's continue on this journey. So right now, the position's done okay. We owned Bitcoin, we bought it, sold some calls. The calls expired worthless. Then we started to rally. And I looked at the vol compared to the first trade when implied volatility was very, very rich. That volatility risk premium was big there, right? We call that the carry, very expensive versus what the underlying was doing for whatever reason. And it was pretty good sale just based on that and the fact that the chart really wasn't showing anything conclusive one way or the other. So sold that, collected that premium, started to break out, and decided to wait, right? We have lower implied volatility, so it's not as exciting for me to sell that, especially in the face of something that's starting to look a little bit better. Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video. Is that a call on where the stock's going? A little bit. I think it looks good. Could I be wrong? Absolutely. It might come down. But the idea is that when a stock starts to really move, as a covered call seller, you have to realize, and one of my other videos explains this in a very detailed way, it can be a sort of negative edge type trade. You're not really getting rewarded for those call sales. Remember, covered calls affect the upside call skew in markets, in individual stocks, most certainly in index. So what that means is the upside out of the money calls are very supply driven. So they tend to compress that upside vol. The downside, it tends to be very demand driven in sort of normal products and certainly in the skew and S&P and products like that. So you can kind of get this lopsided effect, and you have to realize that sometimes you're really just not getting enough for those call sales. And so you really want to keep that in mind. And when the market wants to do some of the work for you, you try to let it do a little bit of that. So it's just about really kind of observing and making an educated call based on the edge that you're seeing. And over time, over having done this for decades and run $700–800 million in overlay funds, option cash flow type funds, and done so many other things in the space, volatility arbitrage, I've just found that that's the better way over time. If you're able to watch markets and kind of be a little bit more proactive about things. So we ran up and I said, well, where's my edge? Well, the option vol, the option pricing, when I say vol, I just mean pricing, got very, very compressed. So I wasn't as excited, but we got to a spot where we had a nice run. We run from about 43, 44 all the way up to 53, 54. So that's a really, really big run. I see a spot on the chart that represents a little bit of edge. So while I don't love the options edge, I do see some other reasons to create some new exposure. And what I did was I sold those 54 calls. So they were slightly in the money at the time. It was above 54. And it sort of bounced around in there, kind of popped up above 55. And now we're pulling back again. And so we're sort of dipping below this uptrend, the sort of channel that I've drawn out here. We've started to dip below that. I can see that we've gone from yellows, which are quite positive, not as positive as greens. You don't see a lot of greens these days in this market, but we have some yellow. We've got our dampener down here that is clearly showing that there's a lot of stress out there. The number of risk metrics go into that, shows that there's a lot of stress out there. So that's going to always dampen our enthusiasm a little bit. That's meant to keep us a little bit on side, a little bit more careful over time. So we see us flipping back to a red. That's not a good sign. We're red. We see the stock dipping below. I'm certainly not convinced that it's going to keep going down, but we have to recognize that this picture has started to change. It's not quite as bullish anymore. So I'm going to hold on to this position. I may end up rolling it down. I'm going to tell you why. So when I look down here at the implied volatility, let me expand that. You can see that it's come down from these levels. So when I sold it before, it was up in here, really, really high implied vol. and we zoomed even higher than that at one point during that big sell-off. And now we've really come down, as so many things have. Option pricing is compressing all over the market in across all assets and throughout the equities world. And so now we're sort of back down into this very low percentile. We could get a little bit lower. So what I would call this move here, when you're short options and you see the implied volatility drop, that's a benefit that you got from your short Vega, right? So when we start to talk about those Greeks again, what Greeks are sort of in the driver's seat? What Greeks do you have to sort of pay attention to? We've got our delta, that's our directional bias. We've got our Vega, which is our implied volatility bias. Do we want options to go up in price, relatively speaking, or do we want them to go down in price? And then so on and so forth, our theta for decay, and then we can get into gamma as well, which I have in many videos. So we've seen a nice little win from Vega. As I like to say, it's like Ferris Bueller, life happens fast, so you better stop and smell the roses. Is that how it went? But anyway, life happens fast, and so does Vega. So your Vega wins can be very, very quick. Which means when you're long options, they can hurt as well. So that Vega exposure is always very important. I don't see enough people talking about that. So our short Vega got us a little win there. Now we may drop a little bit more. So there may be some residual Vega in here if we kind of sit around and go sideways. But at this point, we're probably going to have a little bit more theta takeover. And so we can see this position here. We can see that we have $151 in Vega. So we're going to make $151 for every dollar drop in implied volatility in the June contract. Make sure you don't extrapolate that into August, September next year. Those are different animals, right? Those different expiries may act quite differently from each other, which would be a topic for another lesson, just in terms of how the tail and the dog work and which ones tend to move around more quickly. So, but at this point, we are in the June, which is going to be affected by shorter term fears and greed and fear. So right now, we're seeing it come down. It's compressing with everything else. We've got a VIX down to 24.44. We were a little bit lower a few days ago. We've bounced back up to 24.44 as we go into FOMC. So there's a little bit of nervousness into a sort of macro economic event and some other data. So right now, we've got that little bit of a win, but I'm getting to the point where I'm not as excited about holding on to this. I'm going to give this a little bit of room to continue to pay me in terms of theta, potentially a little bit more Vega. We've got our theta here, which is giving us $81 a day on these 20 contracts. So $81 a day, and keep in mind, this is a big position, over $100,000, but $81 per day, plus that short Vega exposure in case things compress a little bit more. So we're going to let this, as we look at our dashboard here, we can see that we're still long. This is a long position. Make no mistake, cover call position is just a synthetic short put position. So you're still long deltas here. You just have some nice little bit of protection there. So we're going to watch for this, right? This is the easy part when things are kind of working out and sitting around and doing what they're supposed to do for your position. If we start to see this thing break down towards that 50 level, we're going to have to act and probably roll those calls down and start to defend that position a little bit. So hopefully we're going to get a little bit of a bump up in implied volatility. Tough to say how implied volatility is acting on these things. One thing we can do is we can take a look at the skew. So I look at IBIT skew here, and we see that typically you kind of have just a slight bit of upside call skew, meaning that people are paying up a little bit for that upside, which makes sense in Bitcoin. And right now it's even maybe just a touch steeper, or just about normalized, but a little bit steeper than the downside. So we can see that basically, let's take a look at, here we go. So we can look at this scan here that sort of shows some of my, favorite stocks, some stocks that I'm watching that I have on my list I think that are important. You got TLT, you've got some of the more, beta names like Palantir. And you can see that MSTR and Coin, we don't have IBIT on here. I think it hasn't been around long enough to register, but IBIT and Coin and MSTR trading near the low part of this chart, which is low IV rank, and also near the low risk reversal rank, right? So the further something is to the bottom of these four quadrants, the lower the implied volatility is. So look at that. Oh, here's IBIT over here. So we've got IBIT trading near the lows of its implied volatility over the last 52 weeks. We've got MSTR and coin as well trading down near their lows, which is why I've been long MSTR. I've made some money on some long MSTR plays over the last few months. I think that's kind of an interesting place to play the compressed low volatility, low implied volatility. And anything that's towards the left side of these quadrants is low risk reversal rank. So what that means is the puts a little bit more expensive typically than the calls, right? So when the puts, for example, really blow out on a big market sell-off, the puts get super expensive versus the calls, you're going to see everything sit basically right, left on the edge of these quadrants. Now everything's started to drift a little bit this way as that relationship has relaxed, right? Those puts have come down a little bit. The calls aren't really pushing up, but maybe just a tiny little bit. So we've kind of have a relaxing of skew, which translates into these things starting to move to the right a little bit. But you can see something like Microsoft, still quite expensive puts, even though the earnings are out. Nike similarly, Snow, Amazon, Apple, these things still have fairly expensive downside put skew. So that's something that we're seeing in markets a little bit lately. We're seeing people really kind of pile into those downside hedges, not really believing necessarily in the market rally and making sure that they're hedged, right? They want to make sure that they're hedged. So as we sort of move to the right, and markets normalize, we're going to see a little bit better of a scatter plot here, basically like things kind of sitting more maybe around the middle and left and right and upper, left, lower, and that's going to look a little bit more normalized. Right now, we've got things kind of drifting to the right as we get a little bit more calm, a little bit more normalization. When everything just correlates in a huge sell-off, then you see these things all push to the left, and then this becomes less important. You look at something like this, and it's not really giving you a whole bunch of intel on a relative basis because everything is sort of correlated to one. Everything's doing the same thing, which means sell off and high put skew. So it's not really giving you, as a trader, you're kind of looking for morsels of kind of edge and intel within a sample of many names, right? That's what a stock picker does. But stock pickers don't do great in massive sell-offs because everything just goes down, right? So under more normalized circumstances, you start to see maybe some opportunities like, some sectors might be really expensive from a implied volatility standpoint, and some might be really low. You can put on a kind of a pair trade that plays, shorting the high, buying the low vol, things like that. So you can start to look for little bits of edge and opportunity in the universe of stocks once things get a little bit more normalized. And then IBIT over here, you can see very cheap volatility. So implied volatility is very low, but it's starting to get towards the right side here, which means that upside calls are more expensive than the downside puts, right? You kind of have that smirk going the other way. And that's interesting, right? I like to kind of see that because that's a bit more normalized for Bitcoin, right? We tend to see that upside priced in on the call side. So hopefully that gives you an idea. We've got this. Let me just show you the spreadsheet here. So we've got our 2,000 shares, right? That may change at some point if we start wheeling this position. Whatever we're doing, we will reflect it here. So right now we maintain that 2,000 shares, and we sold the April 50s. We got 420 for them. Those were a little bit in the money. So I think at the time they were maybe around, where did we get in here? That IBIT we bought at 50.60, right? So those were $3.60 of time value. So remember, the time value is what erodes, right? The time value is what is susceptible to interest rates, increases and decreases in implied volatility. That's going to affect time value. It doesn't affect intrinsic value. Intrinsic value is just, however much your call or put is in the money, that is sort of set in stone in a way, right? That doesn't really change based on anything except the movement of the underlying. So we got some time value there. Here we got a little bit of time value as well. I should put down where the stock was at the time. I think it was around 54 and a bit. And so now we're just going to let this bake off. Right now, those things are trading a little bit lower, I think around 380, 385. And so we're going to see how this develops. And like I said, I think that implied volatility is getting a little bit on the low side. So now that I've sort of banked and pocketed that Vega win, I'm going to have to decide, do I want to continue to sort of generate this theta at very, very low implied volatilities? And what's going to help me decide that is really just kind of looking at the chart, looking at the broader market, right? Because Bitcoin has been relatively risk on, risk off with everything else, maybe less so lately. But we want to observe everything that's going on out there and then start to make decisions on other positions and this position as well. So that's it for now. We will see you in the next video. And by the way, if you enjoyed this, if you want to see more of it, like, subscribe. I always appreciate that. I'm hoping to have a little bit of a movement going here where we are looking at income, but smarter, right? I want to take this whole idea of the theta gang into the next level. I don't think there's anybody really doing this quite like me with my experience, having managed so much, having done this quantitatively as a market maker, volatility arbitrage. Why am I doing this? I want to keep this movement going and build something special here. So if you like it, if you think you're getting something a little bit extra versus all the other stuff that you can find very easily on YouTube, please show your appreciation, like and subscribe, tell a friend, and we will see you in the next video.